Most people believe markets react to news. A headline appears. Prices move. Good news pushes markets higher. Bad news pushes them lower. That explanation feels intuitive, and it feels comforting because it suggests everyone is reacting to the same information at the same time. But markets don't actually move that way. By the time a headline reaches your screen, it has already been read, debated, and processed by participants operating far ahead of public attention. What feels like a reaction is often just the final stage of something that started much earlier. Markets don't fear bad news. They fear what most people haven't noticed yet. They move when expectations quietly shift, when positioning becomes crowded, when liquidity changes, or when confidence erodes beneath the surface, even if the headlines still sound reassuring. This is why markets can fall on good news, and why they can rise when conditions look objectively weak. The real drivers are rarely obvious in real time. They show up first in behavior, not headlines, in subtle changes, not dramatic announcements. So the question today isn't whether the news is good or bad. The real question is, what changed beneath the surface before most people were looking? That's what we're going to unpack, calmly, methodically, and without emotion, step by step. In the most recent trading session, global risk assets moved lower in a coordinated manner. Major U.S. equity indices, including the S&P 500, NASDAQ Composite, and Dow Jones Industrial Average, declined during the session. At the same time, prices of gold, silver, and Bitcoin also moved lower. The simultaneous decline across equities, commodities, and digital assets reflected a broad reduction in risk exposure rather than weakness isolated to a single market. The equity market decline followed the release of the latest U.S. employment data. The non-farm payrolls report showed job growth above consensus expectations, with multiple headline figures exceeding forecasts. The data was released after a period of heightened attention to labor market indicators, and price volatility increased shortly after the report became public. Despite the stronger-than-expected employment figures, U.S. Treasury yields declined. The yield on the 10-year Treasury note moved lower and traded near the 4.1% level. This decline occurred after yields had already fallen in the sessions leading up to the data release. Treasury prices rose as yields fell, indicating increased demand for government bonds during the same period that equity prices were declining. Equity index performance also showed divergence beneath the surface. Defensive and consumer staples-oriented stocks demonstrated relative strength compared with growth-oriented and technology-heavy segments. One notable example was Walmart, which reached a new all-time high during the same period that broader equity indices were under pressure. In contrast, several large-cap technology and semiconductor stocks were trading below recent highs. Recent consumer spending data referenced from Bank of America's credit card analysis showed a shift compared to prior months. Earlier data indicated spending pressure concentrated among lower-income households. More recent readings showed moderation extending into middle-income groups, while higher-income consumers continued to show comparatively stable spending behavior. Compared with the prior week and the prior month, the key change was not a single data release, but the speed and alignment of price movement across multiple asset classes. Equities, commodities, and cryptocurrencies declined together, while Treasury bonds strengthened. This represented a shift from earlier periods when market declines were more narrowly concentrated or quickly reversed. The importance of the recent market movement lies less in the magnitude of the price declines and more in the sequence and interaction between markets. Equities, commodities, and cryptocurrencies declined at the same time that Treasury bonds attracted demand. This combination suggests a shift in capital preference rather than a reaction to a single headline. When multiple risk-oriented asset classes weaken simultaneously, it often reflects changes in positioning, liquidity, or expectations rather than short-term sentiment. The first-order effect is straightforward. Investors reduced exposure to assets that typically benefit from economic expansion or rising risk appetite. This reallocation occurred quickly, indicating that some market participants were already positioned defensively or were prepared to reduce risk when conditions aligned. The second-order effects are more gradual and often more consequential. As equities weaken, volatility typically rises, which can tighten financial conditions. Higher volatility increases margin requirements, reduces leverage capacity, and can discourage incremental risk-taking. This feedback loop can amplify price movements even without additional negative data. The bond market behavior adds an important layer to this chain reaction. Falling treasury yields alongside equity declines indicate demand for safety and duration. This suggests that some investors are prioritizing capital preservation over return maximization, even in the presence of economic data that appears resilient on the surface. The bond market, due to its size and depth, often reflects longer horizon expectations rather than short-term trading reactions. Sector performance further clarifies the underlying dynamics. The relative strength in defensive consumer-oriented stocks, such as large retail names, contrast with the underperformance of growth-sensitive and technology-heavy sectors. This divergence implies a rotation within equities rather than indiscriminate selling. Capital is not exiting markets entirely. It is being repositioned toward perceived stability and predictable cash flows. Consumer spending data reinforces this interpretation. When spending pressure extends from lower-income households into middle-income groups, it suggests that economic resilience may be narrowing rather than broadening. While higher-income consumers may continue spending, their activity alone is often insufficient to sustain broad-based growth across the economy. Importantly, these developments do not imply an immediate economic downturn. Instead, they reflect changing marginal conditions. Markets respond first to changes at the margin, slowing momentum, tighter liquidity, or reduced confidence, long before those shifts appear clearly in aggregate economic statistics. Taken together, the recent price action matters because it highlights a transition from a market environment dominated by dip buying and rapid recoveries to one where participants are more selective, more defensive, and more sensitive to downside risk. This shift in behavior can influence market dynamics over time, even if incoming data remains mixed or stable. Periods like the current one are not unprecedented, but they are often misunderstood when viewed through the lens of outcomes rather than conditions. Historically, similar environments have tended to emerge near transitions rather than at clear turning points. In past cycles, markets have often shown coordinated weakness across risk assets, while economic data remained mixed or even appeared resilient. These moments typically occurred when expectations had already been stretched and positioning had become increasingly one-sided. In several prior instances, the early signal was not a recession or a crisis, but a change in market behavior. Equity markets stopped responding positively to favorable data. Defensive assets began to outperform. Bond yields declined even as growth indicators remained stable. These shifts often preceded broader adjustments in asset pricing, sometimes months before any formal economic slowdown became evident. What matters in historical comparison is not what happened afterward, but what conditions looked like beforehand. In many cases, markets were characterized by extended rallies, repeated dip buying, and confidence that downside risk was limited. Volatility was often suppressed, and participation broadened as investors grew more comfortable increasing exposure. The transition phase began when these patterns quietly weakened. There are also important differences this time. Market structure has evolved with higher passive participation, faster information dissemination, and greater use of systematic strategies. Liquidity conditions today are influenced not only by economic growth, but also by central bank balance sheets, regulatory changes, and shifts in global capital flows. These factors can alter the speed and shape of market adjustments compared to earlier periods. Additionally, the composition of market leadership has changed. In prior cycles, weakness in defensive sectors often coincided with broader market declines. In the current environment, selective defensive strength exists alongside weakness in growth-sensitive areas. This suggests rotation rather than uniform stress, at least at this stage. History, when used properly, does not predict outcomes. It helps frame probabilities and reduce emotional reactions. It reminds us that markets often adjust gradually, through changes in leadership and behavior, before making more decisive moves. It also cautions against assuming that early signals guarantee a specific result. The value of historical context lies in recognizing that transitional periods tend to feel confusing in real time. Signals are mixed, narratives conflict, outcomes remain uncertain. Understanding this helps investors focus less on short-term noise and more on monitoring how conditions continue to evolve. At this stage, responsible analysis requires thinking in scenarios, not conclusions. Markets rarely move in straight lines, and current conditions allow for multiple plausible paths forward. Each scenario depends on how key variables evolve rather than on any single event. Bull case, reacceleration, and structural resilience. In the bullish scenario, recent weakness proves to be a temporary adjustment rather than the start of a broader trend change. For this outcome to unfold, markets would need to see stabilization in risk assets alongside renewed confirmation from liquidity and growth-sensitive indicators. Equity indices would need to regain and hold above recently lost technical levels, signaling that buyers are willing to reassert control. Volatility would likely compress, and market breadth would improve, with leadership expanding beyond defensive sectors. In this scenario, bond yields could stabilize or rise modestly, reflecting confidence that economic momentum remains intact. Credit spreads would stay contained, and risk appetite would gradually return. Importantly, strength would need to be driven by participation across multiple sectors rather than reliance on a narrow group of defensive or mega-cap names. This outcome would suggest that recent selling was largely position-driven and that underlying confidence remains sufficient to support higher asset prices over time. However, this would require consistent confirmation across markets, not just short-term price rebounds. Base case, consolidation and selective rotation. The base case assumes that markets enter a period of consolidation rather than acceleration or collapse. Under this path, equity indices may continue to fluctuate within defined ranges as investors reassess positioning. Volatility could remain elevated relative to recent months, but without sustained directional momentum. Leadership would likely remain selective, with capital rotating between sectors rather than exiting markets entirely. In this environment, bond yields may remain range-bound, reflecting uncertainty rather than conviction. Economic data could continue to send mixed signals, supporting neither aggressive optimism nor severe pessimism. Investors would likely focus on balance sheet strength, cash flow stability, and relative valuation rather than broad thematic exposure. This scenario reflects a market digesting prior gains and adjusting expectations. It does not require deterioration in economic conditions, only moderation in confidence and risk tolerance. Historically, such periods can persist longer than anticipated and often feel directionless to participants. Bear case, structural breakdown and risk repricing. The bearish scenario becomes relevant if recent signals intensify rather than stabilize. For this path to take hold, markets would need to see continued inability to reclaim key technical levels, accompanied by expanding volatility and weakening breadth. Further declines in risk assets alongside persistent demand for treasuries would suggest a deeper shift in capital priorities. In this case, second-order effects would matter more than headlines. Tighter financial conditions, reduced liquidity, and declining confidence could reinforce downside pressure even without sharply negative economic data. Defensive sectors would likely continue to outperform, while growth-sensitive areas would struggle to attract sustained capital. This scenario does not require an immediate recession. It reflects a repricing of risk driven by changing expectations and behavior. Importantly, confirmation would come from persistence and alignment across markets, not from any single indicator. Across all scenarios, the key distinction is confirmation over time. Markets often test multiple paths before one becomes dominant. Probabilistic thinking allows investors to remain flexible, manage risk, and avoid anchoring to a single narrative before conditions are resolved. When markets enter transitional phases, the most important discipline is watching the right indicators consistently, rather than reacting to whatever dominates headlines on a given day. The goal is not prediction, but confirmation. One key area is the US dollar index, DXY. Sustained dollar strength can signal tightening global financial conditions, particularly for risk assets in emerging markets. Conversely, a stabilizing or weakening dollar can ease pressure and support risk-taking. What matters is not the daily move, but whether trends persist across weeks. Treasury yields, especially the 10-year, remain critical. The relationship between yields and equities provides insight into investor priorities. Falling yields alongside equity weakness suggest a defensive shift in demand for safety. If yields stabilize or rise while equities regain strength, that would indicate improving confidence. The direction alone is less important than whether yields confirm or diverge from equity behavior. Inflation data such as CPI and PCE also deserve attention. but with context. Markets often react more to how inflation affects policy expectations than to the absolute numbers themselves. A key question is whether inflation trends allow financial conditions to loosen or require them to remain restrictive. Sudden repricing around these releases often reflects positioning rather than fundamentals. Volume and liquidity are equally important. Declines on expanding volume indicate broader participation, while low volume moves can reflect temporary imbalances. Liquidity conditions influence how far and how fast prices can move. When liquidity contracts, even modest selling pressure can lead to outsized price swings. Another area to monitor is positioning and open interest, particularly in futures and options markets. Extreme positioning can amplify moves in either direction as trades unwind or reverse. Changes in open interest can reveal whether markets are building new exposure or reducing existing risk. Taken together, these indicators provide a framework for interpretation. No single data point carries decisive meaning on its own. The process is about observing how signals align or conflict over time. When multiple indicators begin telling the same story, confidence in that narrative increases. Until then, patience and discipline remain essential. Markets are rarely as simple as they appear in the moment. What often feels urgent or dramatic on a single day usually makes more sense when viewed as part of a longer process. Right now, the focus is not on predicting what will happen next, but on managing risk thoughtfully while conditions continue to evolve. Periods of transition require patience, flexibility, and a willingness to wait for confirmation rather than forcing conclusions. No single indicator, data release, or price move provides all the answers. What matters is how signals align over time and whether behavior across markets supports or contradicts prevailing narratives. This isn't investment advice. It's simply how I'm reading the market right now. Staying disciplined, respecting uncertainty, and prioritizing long-term decision-making over short-term emotion are often the most effective responses in environments like this.